Greetings. I hope everyone had a wonderful Thanksgiving holiday. We are back in the saddle reviewing the month of November. It really was a tale of 2 months. The first part of it started off not so good, and then the latter part saw a pretty good rally that balanced things out. So in this presentation, we'll be talking about asset classes that are important to our clients, looking at December rate cut odds. I know that's been hotly contested. It looked like the Fed was not going to cut. As data has leaked out, it looks like odds are they are going to cut. Of course, a lot can change between now and a few weeks. We'll look at some seasonal trends for December. We'll look at the bond market. We'll look at gold. We'll look at earnings across global markets. This will be short and sweet. This is a quasi year-end summary, but we'll be posting again next month with a more detailed, longer video. So let's get into the slides. As always, we'll start with asset classes that are important to our clients. You can't ignore Bitcoin, which is the yellow line. Bitcoin sometimes moves without rhyme or reason. There's been a lot of theories about the sell-off in Bitcoin. Some say flows to the ETF have dried up a bit. Some say folks are taking profits. If you recall, Bitcoin was at all-time highs just a few months back. Sometimes it just moves. So this is a volatile asset class like we've highlighted. Sometimes it moves up aggressively. In this case, it's moved down aggressively. Moving on up from the bottom, Bitcoin in yellow. UO is an emerging market index. Has certainly been a really good year for emerging markets, namely China and India, even Brazil. So that saw a slightly negative print on the month. SP, so that's the S&P 500. As you can see, this blue line trended down pretty aggressively. I think we had a 5 or 6% pullback in the third or second week of November. And then we got this little bounce back, this Thanksgiving rally. SCHR, short-term and intermediate-term treasuries, those caught a bid in the month, up about 0.5% and just below 1% for the month. It's not unusual when markets get difficult for investors to flock to the safe haven U.S. Treasury space. VEA, that is an international stock index, then Greater Europe. Again, that's had another good year like emerging markets, up about 26% positive in the month of November. That's the green VEA line here. VNQ, that's real estate. Real estate, or public REITs, as they're often called, is a beaten down, out of favor asset class that is starting to get the attention of many astute and savvy investors. And I personally like REITs. I think they check a lot of boxes, especially for folks that are retired, for folks that are looking for maybe a contrarian play. They're a tangible asset that you can touch. They produce income. And many folks think that REITs are mall space, retail space. I like to call that your grandfather's REIT. That used to be the primary driver of REIT returns. As the economy has evolved, REITs have evolved too. So these are data centers, storage units, cell phone towers, things like that. More of a modern REIT. So don't think that you're buying antiquated retail space or mall space when you're purchasing a REIT. SLYV, small cap value, saw a pretty good rally in the month of November. Again, that's an out of favor asset classes that a lot of investors are starting to like. Historically, small cap value does well when interest rates are going down. And then gold. Gold's been a juggernaut this year, up about 60%. You can see up 5.4% in the month of November. I'll have a few more comments about gold towards the end of this, but if you've been listening to our commentary, our podcast, know that we very much like gold. We're not a Johnny-come-lately in the space. I think there's plenty of reasons still to own gold despite its run here in 2025. So we'll get to gold a bit later. Looking at the month of December, S&P 500 returns in the month of December. There's certainly a seasonal tailwind when you historically look at the S&P 500 in the fourth quarter. We're zooming in on the month of December. So what we've identified is not only what the S&P does in December, but what it does in December based on what has happened the previous 11 months of the year. And this is where we're at. The S&P 500 currently is up over 10% coming into the month of December. When that's the case, there's been 46 instances of the S&P 500 being up over 10% coming into December. Returns are quite good, up over 2%, positive 78% of the time. When you look at all of the observations, 97 observations, still returns are quite good, 1.28% or 73% of the time in the month of December. So December is by far the strongest month when we look at seasonal trends, monthly performance, up even more when the S&P 500 is up 10% or greater heading into December. Not saying this is going to be the case. Certainly, this is a longer-term trend and doesn't apply to 2025, but a lot of people look at this, and momentum in trend investing is real, which is why it's a factor here at Pure Portfolios. Looking at Fed rate cut odds, this might be small, but again, this is smart investors, institutional investors, betting with their capital in the futures market based on what they think the Fed is going to do. And there's an interesting trend, if you heard my earlier comment, where a month ago, the odds of a December cut were only 63%. Now, fast forward to today, I pulled this today, data as of December 2nd, the odds of a December cut are 87%. So employment data has come in softer. There was a few reports that were delayed with the government shutdown. Those are slowly leaking out. Investors are putting the pieces together. Running parallel to that, the Fed governors often give speeches and people pay very close attention to what they say. And it looks like they're leaning more towards a cut. So it wouldn't surprise me if they cut and pause, meaning cut in December, wait and see the first quarter of 2026. Zooming out, and I've said this before, anytime there's an inflection point, anytime there's uncertainty around a Fed cut or a Fed hike where they could cut, they could hike, they could pause, you often see volatility cluster around that, which just means stocks can act quite squirrely. And we kind of saw that in the month of November. So investors will be looking very closely to see if the Fed cuts on the 10th. Again, it looks like that they might, but also the comments, the forward guidance. A lot of investors, wrongly or rightly, hang on every word the Fed says. So that'll be scrutinized very closely for the future rate path on interest rate cuts. Earnings and the composition of returns. So a lot of investors are baffled how the S&P 500 is up this year. And oftentimes I find those investors are mixing daily news flow or politics and investing. Markets really care about earnings. And that's been the story in U.S. markets. And I highlighted that last month. So this is a composition of drivers of return in 2025 across global markets. And I'm not going to go through every single one of these. The first thing that sticks out to me, and a theme that we've been talking about for over a year, is heading into 2025. Global markets were much more attractive from a valuation standpoint than U.S. large caps. And the S&P 500 is one of the worst performing global markets out there. So this vertical axis is returns for 2025, and I think this is through the month of November. You can see emerging markets, MSCI EM, up about 30%. Topics, which is a Japanese index, up about 30%. You got these world indexes minus Japan. This is an all world index, up 25%. And then Europe up about 20% as well. The S&P's up about 15 or 16% as of this recording. But what I'm interested is in the composition of total return. So you can see the total return is in this orange bar, and I just rattled off some of the numbers here. But for the S&P 500, much of the return has been driven by earnings. Returns are a function of earnings. And you can see this light blue bar means earnings per share, EPS, as a contribution as a percent of return. So you can see for the US, the story is really earnings. And I highlighted that last month where earnings came in at the 95th percentile, meaning of all historical readings, this past year, this past quarter's earnings were quite historically good. And again, market returns are a function of earnings. That's less the story globally, where globally, again, heading into 2025, many of these global markets were just much, much cheaper than U.S. markets. So a lot of the return drivers for emerging markets, Japan, foreign markets, are the promise of better days ahead, or PE expansion, price to earnings expansion, meaning investors are more optimistic about the future prospects, the future setup for global markets. And I think that's a theme that still has legs. Some investors have said, hey, emerging markets, foreign markets have done quite well. I don't think they can sustain that. If you look at 2000 to 2009, that was a decade that was really influenced by global markets outperforming U.S. large cap stocks. Of course, the last 13 years has really been the opposite. So this is a trend that I would watch. Earnings have gotten better globally. Earnings prospects, investor optimism or hope for global markets has also picked up steam, and investors are starting to pay attention to this theme. The last thing I'll say is most investors, most prospective clients that we see, even clients with outside assets, are massively, massively underallocated to foreign markets and emerging markets, which means they're massively overallocated to U.S. markets. That's something that I've talked about. I won't beat a dead horse, but I think investors would do well to balance out their portfolios, manage their position sizing in some of the best performing themes, namely AI and tech. We haven't talked a lot about the bond market. The bond market has quietly made a comeback. A lot of folks left bonds for dead back in 2021 and 2025, where we got higher rates, higher inflation, which is bad for all asset classes, but very bad for bonds. And you see this ugly, crooked number here in 2022 for the Bloomberg U.S. Aggregate Bond Index, which is a snapshot of the U.S. bond market. So a lot of investors were throwing in the towel here, and we were actually saying, sure, you want to be mindful of your bond exposures. We don't want to take a bunch of credit risk. We don't want to buy 30-year bonds. But the bond market is really a function of the oldest form of finance, borrowing and lending. That's not going away, folks. So bonds aren't going away. And we said here at the end of 2022 that bonds were perhaps the most attractive that they've been in a decade plus, given that yields were higher, inflation was coming down, and future bond returns are a function of current yields. Well, at the end of 2022, current yields were anywhere from 4 to 6%, depending on the type of bond that you were talking about. And future returns should track closely to those numbers. Well, lo and behold, 2025, the Bloomberg US Ag Index is up almost 8%, and almost no one is talking about it because of what I just mentioned down here. It's really been the lost decade thus far from 2020 to 2025 for the U.S. bond market, an annualized return of 1%, which is well below inflation. But looking back, bonds have been a pretty good producer of income and a risk reducer for diversified portfolios. When equities are coming down, bonds actually hold up quite well. And again, income is back. So again, that checks a lot of boxes for folks that are looking to reduce risk in their portfolio and also generate some investment income. I promised some comments on gold, and here we are. So this is a calendar year, return by year, I should say, summary of gold. And gold's had a really good run. There's a lot of folks that are now starting to wake up to this and want to own gold just because it's going up in value. I think that's the wrong reason to own gold. I think if you understand kind of the macro backdrop, what's not going to change, I think there's a lot of reasons to own gold, but you should know those reasons. So gold up over 60% this year. We've been overweight gold for some time, and I've written about gold since the early days of Pure Portfolios. And I'll say this again, there's a lot of investors that ask what's going to happen the next quarter, the next month, the next year. That's impossible to answer. I think a better question is what's not going to change. And I'm a firm believer, and I think we can all agree, whether you're left, right, or center, that governments around the world, the government in the U.S. has a spending problem, and it's probably not going away anytime soon. Deficits, debt continue to stack up year over year. I don't think there's the political will to change that. The U.S. dollar has lost 25% of its purchasing power over the past 5 years. So a better question is what's not going to change. And that backdrop, in my opinion, is not going to change. So investors want to own stable, sound money assets. What's sound money? Sound money is an asset that a bureaucrat can't print more of. The Fed can't print more of. A bureaucrat can't mess with the supply. It's a fixed supply. Sure, gold can increase in supply if you go into the earth and mine it, but it's a very slow process. And central banks, governments around the world are really buying gold as a store of value. And that's a trend that I don't see really going anywhere. And I know gold can be a polarizing asset class. It doesn't pay income. Folks really aren't transacting in gold, but it's provided a store of value through time, and price doesn't lie, folks. When you look at some of these numbers, when you look at the momentum, the long-term thesis around gold, price is always right. In the last couple of years, certainly the price for gold has been right, up 60%. Now, we're very mindful of our exposures and position sizing, so you don't want to get over your skis. But the last thing I'll point out, a lot of folks I talk to are worried about a correction. And again, timing is fleeting. No one knows when we're going to get a correction, but one is coming. When you look at the rhythm of global markets, I'd say 80% of the time markets go up, 10 to 15% of the time they go down, and 5 to 10% of the time they really go down. So 2008 was about as bad as it has been in my lifetime or my in my professional career. Gold was up 4.3% in the financial crisis when markets were down over 30%. Same thing in 2009. Markets had a really rough start and they hit the bottom March of 2009, but gold was up 25%. Going back to 2022, which was a very painful year for all asset classes. I just touched on that in the bond market, but the S&P 500 was down 20%. Gold was modestly positive. So as a diversifier, as a non-correlated asset to equities, gold checks a lot of boxes. So that's it. Short and sweet. This is a year where diversification is back. Diversification is working. Some of these out of favor other equity asset classes are doing well. Bonds are doing well. Gold is doing well. So again, investors would do well at the end of the year to rebalance their portfolios, to not get over their skis in any one theme. If any of you have a question about how Pure Portfolios makes buy-sell decisions, our quantitative, non-emotional investment process that is built for folks that are retired to mitigate drawdowns, shoot us a note at insight@pureportfolios.com. Thanks for watching. Wishing everyone a wonderful holiday season. We'll see you next month.